Hello everyone and welcome to Jane's 2024 review for January's retirement account. Thanks for everyone's patience. My grandfather has been in the hospital and is probably not going to make it, so I've been trying to spend as much time with him as I can. So I apologize for the delay in the videos, but I'm looking to get these caught up, and let's take a look at some numbers. I also originally had been working with someone on Upwork to try and get some better photos, visuals, make it a little bit just more visually appealing. Been a little bit more difficult than I expected it to be, but the first person had to end up being fired because he did not deliver anything within a reasonable time frame. So anyway, working with someone new, he's definitely been a lot more responsive, and I'm hoping that that can just continue to help improve these videos moving forward. But let's jump into our numbers. So I'm not a financial advisor. I don't claim to be one. This video reflects my own personal views and does not constitute any specific or general advice. Video was made on my own, does not reflect the views or opinions of my employer. I do hold a number of positions in common with Jane. I have those listed on the screen. And then it's a real portfolio with actual shares being traded. I cannot emphasize enough for anyone that thinks this is like a play money or like one of those fake trading accounts. That's as far from the truth as it can be. That's why I take so many screenshots, because I'm trying to do my best to make sure that everyone sees that I'm validating whatever it is that I'm talking about. So for the why behind it, John and Jane were taken advantage of, in my opinion, by their financial advisor, who really didn't disclose some fees when they changed from one mutual fund company to another. And our relationship goes back quite a few years, and basically they decided that they liked the idea of what I was talking about, and I just said, in exchange for me doing this, you don't need to pay me, but how about you allow me to write about this and make it available for other people online to be able to see, so that way anyone that doesn't have someone like me in their life might be able to use some of these tools to be able to take control of their finances on their own. So for John and Jane's background, John retired in 2018, Jane in 2021, both collect Social Security, and that is their only source of income other than what we have with these accounts and like the other small investments they have, but they don't have any pensions or anything else like that. So when it comes to the income collected, they're currently taking $1,700 a month from the taxable account, and then they've been taking $1,000 a month from John's retirement portfolio, but that's going to be increasing here in order to meet the RMD for his account. So that's going to be something that will be updated in his video moving forward. And then they do have, as I mentioned, investments outside of what I help them with, primarily very low risk types of investments. And then John and Jane also have no debt or monthly payments other than basic recurring bills. So they do an excellent job of making my life easy, because when it comes to making sure they have enough income to live off of, they definitely live a frugal lifestyle, and so that makes things easier. In fact, a lot of times I'm the one that has to actually push them to take more money from their account, because it's just not in their nature to want to spend more than they have. So for the headlines here, traditional IRA generated over $1,800 of income in January 2024, and that compares with $1,745 of income in January of 2023. Roth IRA was just over $880 of income in January of 2024, and that compares with just under $780 of income in January of 2023. Traditional IRA balance is actually higher now than it was in January of 2023 by about a little over $7,000. And then the Roth IRA is down slightly, just over $2,000 between January of 2023 and January of 2024. 5 companies in Jane's retirement portfolio paid increased dividends in the month of January, and 1 company decreased their dividend payout, and that was WP Carey, which we had covered in the previous taxable video, but I'll run over that again. So for Alexandria Real Estate, that was a 2.4% increase in the dividend. For EOG Resources, that was a 10.3% increase, and that also does not factor in the special dividends that they have been paying out pretty regularly. So the yield on EOG, if you factor that in, is substantially higher than what their yield is going to show for their regular dividend. And then for Realty Income, the regular 0.2% increase, that's pretty common for the month of January. February is normally when they do their larger annual increase, and I haven't been paying attention lately enough to know if that's happened yet. And then with OBDC, that was a 6.1% increase. They've also been paying out a supplemental dividend because of all the extra income they've been making with rates having risen. So that's nice to see that they're increasing the dividend but still able to pay out a supplemental dividend, so that yield is technically higher than what the regular dividend shows. And then with the Toronto Dominion, that was a 6.3% increase that we saw with them. So for WP Carey, dividend was slashed by just under 20%. A lot of people were quick to abandon ship. I actually saw this as a good move on their part to spin off the office portfolio that they have. And I think that moving forward, the company is in a much better position than it was. It's now a very strong industrial, warehouse real estate investment trust. Great occupancy and great average lease term, so very stable, and I do see the stock bouncing back once the hype or the people that are frustrated with them, all that starts to settle. So with Alexandria Real Estate, just want to point out that total of $577.25 of dividends were collected since July of 2022. But moving forward, because of how much we've continually been increasing the position, it's set to produce just over $457 a year of dividend income. So like I mentioned, that because we keep adding to the position, that's going to be generating quite a bit more than what it was initially. And then with EOG Resources, anything under $110 a share is in my opinion a great buy point. And then if the stock price moves back up over $120 a share, I would look at eliminating the part of the position that's underwater right now. And the main reason with that is just to, again, keep focusing on moving that cost basis lower. But you can see that the total amount of dividends collected is $91.92. And even though it's not producing that much annually, even though it hasn't even been a full year here, the reason why we've collected so much in dividends from them is because of the special dividends that they have been paying out that I mentioned. And then for Realty Income, you can see here we haven't added to this position since May of 2021, so it's been pretty stable since the March of 2020. It really hasn't had a lot of increase in terms of the number of shares. But we've collected in the account just under $1,500 of dividends, and then moving forward with the increase, we're looking at $415 annually of dividend income collected from Realty Income. And then for OBDC, Blue Owl Capital, here we've got the $348 of dividends collected since July of 2023. And then moving forward, we expect to see $420 based on the size of the position currently. That does not include the supplemental dividend that they have been paying out. So that's going to be something that would be in addition to the $420 annually. And then for Toronto Dominion, in this case, Jane's collected just under $2,200 of dividends since April of 2020. And then after the dividend increase, it's only going to be producing about $152 annually. As you might notice, that's a pretty stark difference here. And the big reason why is because this position used to be about 4 times larger than it currently is. We've been cutting back on Toronto Dominion and other Canadian banks simply because of concerns about their lending environment, the real estate environment, and the basically the affordability crisis that exists. The way that they hold their mortgages, there's a lot more risk on the banks themselves. So I've just been slowly trimming those positions back just to be more cautious with it. Now with WP Carey, you can see that they have paid out nearly $3,200 of dividends since April of 2020. After the dividend increase, the current position, or decrease, the current position is set to produce $688 of dividend income annually. So you can see here that, you know, compared to what was collected in 4 years here, which is about $750, the dividend is not that much different because we've added more shares over time. So even though it was cut by 20%, it's still not substantial compared to what other cuts have been for other companies that are actually struggling. So for January trades, everything was a buy in January for the traditional IRA. That includes a certificate of deposit, but also Alexandria Real Estate, EOG Resources, and then BlackRock Health Science. For BlackRock Health Science, we do not invest in pharmaceutical companies, and the main reason why is there's just too much research that would need to be done in order for me to say that I feel competent about the pharmaceutical and medical industry. And so what we said a couple of years ago was that basically investments in the pharmaceutical companies, really it's going to need to go in the form of like a BlackRock Health Science Trust, like a closed-ended fund. Because in this case it produces the income that they want, but gives them the exposure to that industry, but also is managed by people that are smarter than I am, especially when it comes to the pharmaceutical industry. So anyway, that's been one that we've continually been adding to in small amounts of shares. And then for the January trades with the Roth IRA, we did purchase shares of BP. I said that the stock looked attractive under $35 a share, and in this case it was under $34 a share. So we pulled the trigger on 25 shares there. And then for Bank of America and T. Rowe, we did sell off a chunk of the positions for each one of those. In this case for Bank of America, it was the high cost shares, and actually, sorry, for T. Rowe, it was also the high cost shares that were sold. And then for the realized gain loss, nothing to be able to show in January for the traditional IRA since nothing was sold. And then in the Roth IRA, though, that's where you can see that for T. Rowe and Bank of America, made a little bit of money on Bank of America, but it might as well have been a break even. And then for T. Rowe, it basically also might as well have been a break even. We had another 25 shares that were purchased at about, I believe it's a cost basis of about $98 a share. So this was something, again, just eliminating this. T. Rowe has been moving up in between $100 to $115 now for quite some time, and so this was a great opportunity for us to kind of offload those higher cost shares and then potentially add more if we see that stock price move down further. And then our year-to-date numbers here. These are year-to-date numbers are, excuse me, good through February 19th. So you can see there's been a little bit more trade activity going on here, but that won't be shown until we do February's video. So for the traditional IRA comparison year over year, you can see here that Charles Schwab money market and CDs represent a huge shift in where the income is coming from. No surprises there because we've talked about this a few times. But the reduction in the size of positions for Digital Realty, Iron Mountain, and Philip Morris, you can see the reduction in dividends earned from those accounts, and that's because of us trimming back the size of those positions. And then also on the increasing size of positions, we had Alexandria Real Estate and then also the BlackRock Health Sciences Trust. And then for the Roth IRA, ADC and RNP positions have increased pretty substantially and produce quite a bit more income than they did previously. As I've already mentioned, the reduced exposure to Toronto Dominion, and then interest income from CDs and from Charles Schwab money market does represent a sizable amount of income moving forward. And that's going to continue to grow, but it's a substantial amount, especially when you consider that it wasn't until towards the end of last year that the Roth IRA was earning interest from Charles Schwab money market or from CDs. So for the year-over-year full comparison here, it was estimated that negative 21% income growth in traditional IRA dividends, and again, that's with us going for the least optimistic scenario, and in fact, the negative 21%, what that is not taking into account is the income earned from certificates of deposit and money markets. Because we want to, again, truly err on the side of safety. So it's likely that this is a overstated loss. Like we're saying that things are going to be far worse than they actually are. So this should improve pretty rapidly. And then the Roth IRA, which is not as dependent on those the income from from money market funds and from certificates of deposit, but it's increasing. But this is looking at close to about a break even, and again, this is the worst case scenario. For the traditional IRA, the income for the month increased 3.24% compared to January of 2023, and then for the Roth IRA, the income increased 13.21% compared to January of 2023. So for the account balances, we've already mentioned these before here too, but it is a good place to start in terms of seeing that the average balance is higher than where the average balance ended in 2023 for both the traditional and Roth IRA. No withdrawals have been made out of these accounts. All dividends and interest collected as cash. And then also there are no funds being contributed into either account since John and Jane are both retired and do not have qualified income. And then the 7-year traditional IRA comparison here. Again, I added in the 21% down here. We'll see how this continues to change over time. But the track record of this account is that it's been able to grow its income every year for the last, several years by at least 10%. So anyway, I found that to be pretty impressive here and gives me confidence that we're going to see a much stronger number here for 2024. And then also, we dig into these incomes a little bit more in terms of like the money market and the certificate of deposit. I have another table that I created that I think will help clarify some things. And then for the Roth IRA, even if we start with our conservative figures, we're looking at a 0.5% increase year over year. I expect that number is going to be, close to what we've seen historically here, probably high single, low double digits. And then the cash balances. So cash balances do not reflect balances held in money markets or CDs. There's currently $110,000 in the traditional IRA in these instruments and another $30,000 in the Roth IRA. And then for the unrealized gain loss here, so we can attribute some of the decrease in unrealized gains to the number of positions sold or reduced that were sitting at large gains too. So when you take those large gains off the table, it's going to show that the potential unrealized gains, the ones that you haven't actually acted on yet, are not doing as well as they would have been. So when you sell off a position that has a lot of gains with it, it can distort things a little bit. Now for the current gain loss, this has been updated from, I believe I did it yesterday, so pretty much from market end of 2022, end of day from the market and from February 22nd. So in here you can see the gain loss function of it. One of the things that I added to this, and I mentioned this in the taxable video, is that I did add this additional column here so that everyone can see where that income comes from, because part of it is that it's not enough to know what the percent of the portfolio is for that position, but to also know how much is the income that the portfolio, how much of the portfolio's income is dependent on that specific investment. And so like a good example here would be to see, okay, ENB, Enbridge, 4.81% of the account in terms of the total balance on it, but then in terms of the total income produced, it's 8.17%. So even though the position is relatively, modestly sized, because of how much dividend payout it has, it's something worth paying attention to, that's for sure. And then for the Roth IRA, you have the same thing here. I added this column about the percentage of income. And also I want to point out too with this that red isn't necessarily bad. It's just meant to draw attention to a higher percentage of income being generated by that investment. So just know that, like in this case for RNP, I'm comfortable with this both being red because RNP is diversified, right? But if that was a single company that was responsible for producing, nearly more than a quarter of the portfolio's income, then that would be something that would be pretty important to to be aware of. And then this is the table that I was mentioning that I made some changes on that I think will be helpful for folks to see moving forward. Because basically in this column here, what we want to do is we wanted to isolate, okay, how much income is actually coming from dividends. So dividends being stocks where they're eligible for increases and things like that. Excuse me. But when it comes to CDs aren't necessarily eligible for dividend increases. It's not like there's a variable rate CD, at least not one that I've seen available. But we want to know how much comes from the things that aren't going to be receiving increases, or if it does receive an increase, it's going to be because interest rates were higher, or were lower at the time that they did their previous CD, and then now that CD is expiring, if that rate is higher, then they would end up earning more by putting it back into a CD again. But then we have our total income column here, so you can see based on the update of January, but then all the rest of our estimates here, that the increase year over year is at 0.4% currently. But for the month, that was a 3.24% increase when it comes to the traditional IRA. And then for the 3%, 5%, and 7% columns here, I just included these numbers just to offer a benchmark so that you can see what that looks like to have had a 3% increase over 2023's income, or a 5% increase over 2023's income. And then for the Roth IRA, same exact thing here where we've separated it out. Again, it's less reliant right now on certificate and money market income. But this one was a pretty substantial increase for the month of 13.21%. And as of right now, we're forecasting a pretty strong return here for the portfolio. And again, this is assuming that the other 11 months of the year perform as shown on here. And this number for total, or for the total income column, is the ex CDs and with CDs columns added together to get to this. So situation seems similar to what I've talked about in recent videos. Cash balances have increased substantially with the reduction or elimination of certain positions that no longer present a compelling risk reward. One of the things that I actually had mentioned in the article I published on Seeking Alpha was how Meta is now paying out a dividend, and the potential that that is going to spread to other stocks like Google and other tech companies in particular. That'll be an interesting thing to play out, because as you can tell in the portfolio, we don't have a lot of exposure to tech, and a lot of that has to do with tech is not normally known for providing the strong or compelling yields, because it's more of a growth-based industry. Yeah, let me know if you guys have any questions, comments. Again, sorry for the yawns, sorry for being tired. I am getting John's video, excuse me, put together. So his article will be coming out soon on Seeking Alpha, and I will be doing his video here shortly as well. But yeah, any thumbs up, likes, comments, all those things help with the YouTube algorithm, which I've had a terrible time attempting to figure out. Yeah, I do appreciate everyone's time, and thank you so much for watching, and take care, and best of luck with your portfolio.